Hi everyone, and welcome to Investing Strategies. It's Alissa Coram with Investors Business Daily from the NASDAQ market site in Times Square. With global growth concerns and signals of economic softness here at home, this week it's all about how to position your portfolio holdings for Q4 and beyond. Edward Jones is here to share insights about the asset classes you should be paying attention to, and with the presidential election around the corner, why you shouldn't play politics with your portfolio. Plus, we're analyzing the chart of an international standout that's forming a rare but bullish pattern. The details on that in this week's technical analysis. And we're sitting down with a financial advisor to discuss ETF strategies to deploy in this choppy headline-driven market. Investing Strategies starts now. Okay, let's kick things off with our market insights this week. Joining me for today's discussion is Neela Richardson, investment strategist at Edward Jones. Thanks so much for being here today, Neela.
It's a pleasure. Thanks for having me.
All right, so we did see quite a bit of optimism on Friday with hopes of this trade deal, but it looks like we now have uncertainty creeping back in as this is still an ongoing issue. What are your thoughts on what's happening in the market right now?
What's playing out with trade in the markets is exactly what we should expect and what we at Edward Jones have been talking to our clients about. First, we think a deal gets made, but it's going to be a long process. These are not easy issues. They're very complex. It's not going to be a one and done deal. Secondly, we have to look past some of the rhetoric and look at the actions that are taking place. Namely, are tariffs removed? We have not seen an indication that tariffs will be removed as a part of this phase one deal. And then finally, we have to expect volatility. The markets have been very reactive to any news on trade progress, either good or bad. So this is part and parcel of what we've seen in the markets since May when it comes to trade.
Right, and of course these trade issues are tied to these global growth concerns that we're seeing. So how should investors be facing these concerns of a global growth slowdown in their portfolios when, like you said, there is a lot of volatility and uncertainty?
Well, the first thing we think is you have to have a very realistic perspective. Yes, markets are a bit more volatile, but it's not out of the normal range. In fact, you should expect a dip, a 10% correction in S&P 500 returns at least once a year. We haven't seen a correction yet. So we're actually kind of in a lower volatility state than usual, and that's important to keep in mind because volatility has been so absent from the market the last couple of years. And secondly, we don't expect a recession either in the US or globally. We know that growth will continue, but at a slower pace. That is entirely expected. So news of a slowdown in growth shouldn't take you by surprise. We don't get this big boost from the tax cuts anymore. Those are starting to fade. So growth is also fading in the US and we think around the rest of the world. And finally, where should you position? Well, the best thing for a retail investor is stay in position.
All right, yeah.
Because the final 2 years, it's been shown in the data, of a bull market is associated with over 20% annual return. So the last thing you want to do is let a headlines, cause a jitter.
Right.
And for you to pull out of the market. So we're telling our clients to stay invested, make sure you have enough bonds to maneuver through the ups and downs, and don't worry too much about the day-to-day headlines.
Right, I think that's a really good point to put in perspective that we haven't seen that 10% pullback yet. Maybe we're just, getting too picky with what we're seeing in the market because we did see such a big run up earlier in the year. Right. So really good to put all of that in perspective. So with all of that said, given the backdrop of not only trade, but also the political environment. I think that's another issue. You mentioned the headlines, and with an election around the corner, how should investors be positioning themselves, or should they try to get tactical heading into the next election, or is it still good to just stay in the market?
My best advice is don't make your portfolio partisan, right? Vote at the election booth, not in terms of your asset allocation. That's really important to remember. Even as we hear more about this impeachment inquiry, history teaches us a few lessons. The first lesson is, stock markets have returned about 10% annually despite whatever configuration of political parties were in the office, whether the Democrats were in the White House or the Republicans, it didn't matter who controlled Congress, we still had the stock market returning about the same amount year after year on average. Secondly, what's important to remember is that politics matter, but they're unpredictable. Policies are unpredictable. And we've only had 2 instances of an impeachment process, like one that is being contemplated now. And what was shown in each of these instances is that history, the economic fundamentals mattered more than the politics. So during Nixon, we had high unemployment rate, we had oil prices that were spiking, we had a Fed that was hiking interest rates, and we saw stocks drop 10% over the next 6 months of that process. During the Clinton impeachment process, we had stocks return 34% over the next 6 months because of a stronger economy. So right now we have a pretty solid economy, and we think that continues despite Washington's impeachment processes.
So the economy is still holding up even with some of these headlines about slowing growth. The underlying growth is still there and still positive?
Right. We still think it all goes back to the consumer, and we've seen the consumer be resilient over the last 10 years of this expansion. That continues, though we are worried about slowing global growth. We are worried about the next installment of tariffs. We do think there's rising risks, but as long as that consumer stays strong, we can stay positive in our outlook for the economy.
Okay, well, let's take a look at how exactly investors should be positioning their portfolios in terms of the asset classes they should be looking at. What are you seeing in terms of the opportunities that are out there for investors?
Well, we're at the late stages of the bull market, so we're taking an approach that you should position yourself for more volatility. So even as we are neutral on equities overall, we think that fixed income also plays a role in cushioning what we know will be a more bumpy road ahead. But we are seeing opportunities in international equities, both developed country equities and emerging markets. Now at Edward Jones, we recommend broad-based indices instead of individual countries. But when you look at valuations of these companies in different parts of the country compared to the S&P 500 companies, they're really a good buy for a long-term investor. So that pessimism actually works in a retail investor's favor if they have a long enough time horizon.
Interesting. Yeah, that does seem a little bit contrarian. So it's mainly a valuation standpoint that you're looking at, or?
It is in terms of when to buy. We think that the assets are attractively priced, but there are some secular trends that are really going to make emerging markets especially a good long-term bet. One is this transition. You see it in China right now, this transition from an export-driven economy to a consumer-led economy. Over the next 10 years, we think that those open markets to consumer goods really helps benefit emerging market equities. In the developed world, we're seeing a firming, though Brexit, you have to put that aside sometimes, a firming political structure, a good leadership team, and accommodated central banks that we think can lead the Eurozone through the next year to 2 years and really stabilize growth in that area and lead to stronger returns for companies ahead.
And when it comes to international and emerging markets, do you think that the bull case strengthens pending on if and when we do get a trade deal between the U.S. and China and how all of that shakes out?
Trade is definitely a catalyst. We've seen firms pull back because of the trade tensions and uncertainty in the U.S. Corporate America doesn't always know where to invest abroad. There's been a disruption of supply chains, and you've seen that around the world. So this has been a very disruptive part of the global economy, and a trade deal between U.S. and China not only benefits these countries, in fact, it might benefit the rest of the world even more.
All right, well, it's definitely been a bumpy ride over the last few months, but it's always good to take a step back and provide that perspective, which you did. Thank you so much, Neela.
Well, thanks for having me.
All right, and speaking of international stocks, after the break, we're going to take a look at a top international stock to watch and analyze the rare chart pattern it's forming. We'll be right back.
Pick winning stocks with MarketSmith. Growth 250 shows you ideas with big potential. View charts packed with key data. Use pattern recognition to see action zones. MarketSmith by Investors Business Daily. Try 3 weeks for $19.95.
Utilizing chart patterns when you're investing is key to making sure you're buying and selling at the optimal time. Common chart patterns include the cup with handle, double bottom, and flat base. But today we're going to talk about the ascending base, which is a rare but powerful pattern. The ascending base forms when a stock has 3 consecutive pullbacks, each with higher highs and higher lows, kind of like stair steps. And the pattern typically develops for strong stocks in a not so strong market. And once the market moves higher, the stock is free to continue its advance. So let's take a look at an example of the ascending base to explain. Now, Chinese stock New Oriental Education is working on the ascending base with earnings due towards the end of October. New Oriental is a member of the IBD 50 list of leading growth stocks, and it's China's largest provider of private educational services with more than 8 million students through its network of 95 schools. And the stock has done a tremendous job of shrugging off the broader market weakness amid the US and China trade war. And as you can see with this chart pattern, there are 3 pullbacks, each with higher highs and higher lows. Now, a proper ascending base pattern usually develops over 9 to 16 weeks, and this one has been taking shape for about 15 weeks. With the ascending base, each pullback should be limited to no more than 10 to 20%. And it's normal to see these pullbacks take the stock to its 10-week or 50-day moving average. That's the red line on the chart here. Now, this base has formed during a choppy, volatile market, with the retreats coinciding with general market weakness. That's a key feature of this pattern. And once the resistance from the general market disappears, stocks that form the ascending base are free to make their advance, kind of like removing a heavy weight off of a coiled metal spring. And for New Oriental, that weight could now be lifted off with the Phase 1 trade deal between the US and China, but we'll definitely keep an eye on the headlines. If New Oriental tries to break out, look for heavy volume, as that would indicate support from institutional investors. It's also ideal to see the relative strength line, which measures price performance versus the S&P 500, hit new high ground. Now, for New Oriental, its relative strength line is currently just off highs and reflects solid market outperformance. And in addition to the bullish chart, it's of course important to focus on stocks with strong fundamentals as well. New Oriental is expected to see annual earnings growth of 32% this year, followed by another 31% next year. The best growth stocks show annual earnings growth of at least 25% or more, so that's positive here. And with another earnings report on the horizon and progress made on the trade war front, New Oriental has all the ingredients of a bullish setup with this rare ascending base. All right, well, when we come back, we're going to discuss some ETF strategies to consider in today's volatile market. That's happening right after the break.
This season on Cultural Capital, we are in New York City and San Francisco. Come with me as I tour some of the world's most innovative companies, from Squarespace to C3AI, Giphy, and Figma. Learn how CEOs built growing companies while maintaining the ultimate office culture on Season 3 of Cultural Capital on the brand new NASDAQ.com.
Now let's discuss ETF strategies to deploy in today's volatile market. With me is Patrick Healy. He's founder and president of Caliber Financial Partners. Thanks so much for joining me today, Patrick.
Pleasure.
All right, so how are you as an advisor utilizing ETFs in your clients' portfolios right now, given the intensely, I guess you could say, volatile market that we're seeing right now?
Sure. Well, I do manage for a lot of retail clients, and I do trade equities in addition to ETFs. But I use ETFs as a way to implement a strategy that would be otherwise difficult to do on your own. It's a very efficient and cost-effective way to tap into specific sectors or geographies, or to better manage some of that volatility that you're talking about.
All right, well, let's talk a little bit more about your investment philosophy. What kind of mix of tools are you looking at and deploying in these portfolios?
So I tend to take a barbell approach with most clients, and obviously it depends on their risk tolerance. But I will look for growth opportunities in specific high alpha sectors. And at the same time, I will err more on the side of income-oriented investments, whether it be dividends or interest, on the risk-averse side of the portfolio, trying to drive an average return that is sufficient to allow people to live a comfortable lifestyle.
All right, and are you noticing with your clients, are they asking more to be invested in ETFs, or is it something that you're really having to educate them on in terms of the benefits?
Yeah, so I tend to have discretionary authority on all of the accounts that I manage, and so a lot of times they're leaving that decision up to me. But I think a number of clients will have questions about their portfolios, and so I spend a lot of time trying to educate them on why we're buying certain names and why we're avoiding certain sectors, why we want to take on more risk in certain environments and why we want to pull back in other environments.
All right, and in terms of, I guess, the asset allocation, you mentioned being in high growth areas. What percentage of the portfolio typically is allocated to that, or does it depend on what's happening in the market?
Depends on a lot of things. It depends on how old the client is, whether they're approaching retirement, their personality or psyche. A lot of times, whether they're old or whether they're young, some people are just uncomfortable with a certain amount of risk. And so I have to shy away from that for someone that's going to be uncomfortable with seeing day-to-day volatility. So certainly the age of the client and the risk tolerance and their psychology, so to speak, but also the environment we're in, where we are in the market cycle, where the economy is. We're heading into an election cycle next year, which I would anticipate there being quite a bit more volatility as we get through the year and approach November election. So a lot of it has to do with just the environment we're in and obviously the individual's personality.
All right, and you mentioned that you're, of course, investing in individual equities for your clients, but in terms of ETFs, what is it about that wrapper that makes it attractive to you?
So there's a number of things. It's a very efficient way to spread risk over a number of names, whether it is in a specific geography or a particular sector. It's very cost effective. The fees are very low, and that's something that we have to be very cognizant of as we're managing money for clients. And so those are kind of two of the factors that I really zero in on when I'm using ETFs.
Okay, and taking a look at the environment right now, what areas are you looking at in terms of ETFs that you really want your clients' money to be in right now?
Right. So I tend to spend a lot of my time doing research on biotech. It's a sector that has quite a bit more volatility than your overall market. That's where a lot of the outsized gains are, though, if you're fortunate enough to pick good names. At the same time, individuals, as I mentioned a minute ago, tend to be a little uncomfortable with a certain heightened volatility, and so utilizing ETFs to spread the risk around among a number of names tends to be a better way to get exposure to the sector.
Yeah, that's right, because with not only is there risk with the earnings reports, but you also have all of these trials and the trial data that's coming out that can either be, causing the stock to skyrocket or plunge. So you're right, there does seem, at least on an individual basis, a little bit of added risk with holding a stock when you don't know or what the results of a trial are going to be.
Sure. I'm not a scientist, right? But I do follow closely drug trials, FDA decisions, advisory committee meetings. Certainly earnings will be a motivating factor for a stock price of a biotech stock up or down. So there are certainly catalysts that dictate an outsized return up or down for those names. And you might look like a genius if you pick the right name, but if you're having to be patient and have a lot of resolve in particular names that might be depressed at a certain time before those catalysts or those investment theses play out, it just creates a situation where your average retail investor can get impatient, can get uncomfortable, and make an emotional mistake. And so that's something that I try to avoid.
Yeah, that's a really good point, because the business model is, of course, also different in terms of it takes a while for profitability to come in. But as you mentioned, it seems like over the long term in this space, being able to capture all of these, for example, new drugs that are coming to market that are just creating really great opportunities, not only in the healthcare space, but for investors as well, seems like something worth following and worth looking at ETFs to track that group.
I spend a disproportionate amount of my time doing research in that particular sector, and it's funny. You can have a company that does really well and the investment thesis plays out and the stock goes up several fold. But inevitably, it's human nature that individual investors will want to focus specifically on the names that are down and ignore the ones that they've done quite well with. And one of the things I have to reinforce with clients is I'm trying to drive overall portfolio returns. I am not going to bat 1,000. I'm going to have names that don't play out the way that you hope that they will, but the goal is to overcompensate with the names that do play out.
Right.
And I'm sorry to interrupt you, but I think an ETF structure or wrapper in that particular sector is a good way to kind of smooth out that risk.
Right. You mentioned the batting average, so I was just going to say that's why it's so important to diversify. And speaking of, let's talk about a couple of other areas that you're looking at right now.
So I also spend a lot of time investing in commercial real estate, and so ETFs are a good way to gain exposure to specific sectors. Energy is a sector that has experienced a lot of volatility over the last several years. We saw crude prices go down rather dramatically back in 2016, and I think that has shaken the confidence of investors in the energy sector. So as a way to kind of gain exposure and spread the risk around, I think that's another sector that an ETF wrapper is a good tool for.
Okay, and then what about on the dividend front? Because a lot of financial advisors are liking to seek dividend stocks, or I guess ETFs, especially during times of volatility. What do you say?
Certainly in times of volatility, it's a great portfolio stabilizer. Cash is king when you have volatility, and especially if there's a correction, it allows you to take advantage of maybe a lower entry point. So when you have cash coming into the account consistently, it's a great way to kind of stabilize your portfolio. Also, a lot of retail investors, as they approach retirement, need that income to live off of. And so it's a good way to kind of allow them to support their lifestyle in retirement, supplement Social Security and any other income that they may be earning.
All right, well, Patrick, thank you so much. It was really great getting to look inside the mind of a financial advisor and how you're using ETFs. Thank you.
Thank you.
All right, and thank you all for watching Investing Strategies. We'll see you right back here for our show next Monday. Until then, I'm Alissa Coram.